Good morning, traders. My daily video. I know some of you complained about my video audio on a couple of my last ones, so I put my headphones on today. Things we got going on here, guys. So this is the 100-year trend channel that I got going on SPX on a weekly basis here, and I started with that. One second here. Change this here. Zoom in here to the small time frame here. Just takes a second here. So in my opinion, that we're kicking off the first of the year. I had the thesis going into this week, the past couple weeks now, that we were in a blow off top phase of the market above this 100-year trend line, and that at the very least we would backtest the breakout period for this trend line going into the first of the year. And guess what, guys? If you zoom in here on this trend line, and we just missed tagging my target. Just missed it. See how we just missed that target to close the year out. So I was looking for a flush into the close there Friday, which we didn't quite get. So they managed to hold it up just a little bit. I still think we're probably going to first part of January. We're probably going to at least tag that line, maybe overshoot it a bit. We got the weekly 20 SMA here as a magnet as well. So there's two little targets there, suggest that we're still probably not done this week to the downside, in my opinion, here on the weekly time frame. So heads up on that. Ultimately, I am of the thesis that this is a major blow off top in the market, that we're ending the year in a major blow off top. Now, I could be wrong. I mean, we could just be coming down, doing a back test, going off to all-time highs. I know a lot of people are talking 70 over 7,000 on the S&Ps, and that could very well be the case. But just be very mindful here. Uh, this is the 100-year trend line. You know, we've been all kinds of fair value gaps on this way up here. All kinds of internal structure that should be repaired to the downside for a to find a sustained base in the markets. And until we get that, I'm thinking this as a major inflection point that we can actually come back down. I'm thinking that we might have multiple 10% drawdowns in the market in 2025. I think volatility is going to be jacked up. You're going to have two-sided trade. You're going to get in the habit, you get a 2-3% move on any equities, you're going to be ringing the register, and you're not going to be wanting to stick around too long on the trades. I think it's going to be a total, complete different type of market than what we're used to. And if you're not an active trader and very good at actively trading, you are not going to fare very well in the 2025 calendar year. Other things that I'm thinking about here. Typically, if you have a bad Santa Claus rally event, you have a return in single digits. So I am thinking by year's end that we're going to probably have a 5% or less, possibly negative, potentially negative, annualized return on the S&Ps and the Nasdaq. So be very mindful of that we're so used near 20% returns, you know, um, in these markets that this we're flipping the script on uh, what kind of markets we're going to be in. So just be very mindful of that situation. Okay. Okay, guys, I have my SPY chart, and then I have my SPY over here on the volume leaders. And at this level, when we came down to this price point, we had buyers step up last time after the FOMC. So we're not dead yet. Okay, we're not dead yet. What we had was the very next day, Europe came in, dumped us. We started feeling the fair value gap to the downside. Okay, but it was immediately bought back up because we had these big trades right here. Now, a lot of times traders are sitting there thinking, "Oh, they're buying the dip," which that could have very much been the case at that point. Okay, guys, but now that we're already losing this, and anybody who's any got glasses and not blind can see that we have a head and shoulders pattern right above that 100-day or 100-year trend line. So in my opinion, putting a head and shoulders in above a 100-year trend line, that is a major, oh my God, moment. Okay. So, in this situation, we got these lows right here, right now. We put our fibs on here. Okay. Fib extensions. If I can get it to work. Give me a second here. I'm not gonna do it off the wick. We'll do it right there. Fib extensions. And down here to the low. This was that week's fair value gap low as well. Okay, so now we are looking at way down here, 555 down here, potentially here on the S&Ps. Okay, so be very mindful of that. The 555 on the S&Ps is a potential target setting up here. If if this is a breakdown pattern, wouldn't you know? Every time I start talking, the cat comes in here. So be very mindful. So we did have into the close. We did have a big trade come in at 4 o'clock there Friday. Okay, so could they be buying the dip again? Yes, that is a definite possibility. But I do want to point out the sizing of the dip buy after FOMC was larger than the sizing of the dip buy or the dip trade uh, for the end of year. They were different. Okay, and the prior. I also want to point out last Friday at 4 o'clock. That was the last full trading week of the year. We got some major size trades that hit the market, and mostly in tech land. I mean, they were Microsoft, Apple, Nvidia, Tesla, Amazon. They were all big institutional trades that were hitting last Friday, the last full trading week of the year. Okay, and wouldn't you know, we see how it resolved. It all resolved lower. Okay, so now we have to sit there thinking, has the script changed? Has potentially, now that we got the end of the year, all kinds of profits on the book for 2024. Are they going to come in here and immediately start selling into this rally, selling into this strength, and which I think is a very good possibility. Okay, so be very mindful of that. So let me get over to my next charts. Give me a second here. Okay, traders, continuing with my little video here, guys. Oh, I forgot to mention the orange areas represent fair value gaps. Okay, areas of low volume that they tend to slice right through those areas like a knife. Okay, and then also I got the expected market maker moves for the week. And as you can see, this was the FOMC expected market maker move. Okay, and we didn't even quite get to that, last week. So be mindful of that. Had some strength in the markets last week and stuff, which that script seemed to have all changed here. So Qs have been showing some relative strength here in the markets. One main takeaway that I do have here, comparing these two charts, we did break the uptrend. Okay, we had some big buyers here, right at this price, or big orders that filled that actually looked like dip buyers coming in. We're still in that range right here where the dip buyers came in after FOMC on the Qs. So it's not a broken structure yet. Okay, let me reemphasize yet. Okay, and the thing was, we closed out the year and there wasn't any major big trades in the Qs to close the year out. So that was a little bit shocking to me to see that the Qs weren't actually getting a major. So that suggested to me that this auction to the downside could very well not be concluded because big money buyers were not willing to step up. You weren't getting any big money buyers or big money sellers coming in. So this trend may not be completed, knowing that scenario going forward into the rest of this week. Similar situation. We had large trades here on the Russell, which didn't manifest in any positive action. And you see how this big fair value gap is here, fair value gap's here, with a head up here. This really looks like a head situation, a blow off top head situation for a bigger head and shoulders scenario. So be very mindful of that. So basically, we have an exhaustion move to the upside with very low volume on both sides of the exhaustion move. This is a very high potential head and shoulders. I think the cues weren't really showing it quite as clear, but this is a really looking like a clear head in a possible head and shoulders situation here. And similar situation, here we are, we go into the end of the year, and we didn't really get any large institutional trades, suggesting this pattern could very well not be completed to the downside. Similar situation with our diamonds here, guys. You see all these fair value gaps, you know, suggesting a head formation and a potential head and shoulders formation. We're getting a bunch of trades down here in what could be the right right shoulder. So it's not, these trades aren't giving us a directional suggestion. It just says the institutions are actively trading this level. So be very mindful of this, okay? Institutions are actively trading this level. And also, this is here is more dark pool stuff that's hitting here instead of real-time trades, suggesting they're trying to do this under the hood and suggesting it, not guaranteeing it, but suggesting they're trying to get these trades in under the hood before the end of the calendar year. So be very mindful of that. Okay, I'm going to try to go through these a little bit faster here, guys. So just last week, remember, guys, we were down down lower here, the 248 area here on Apple. We've had a bunch of institutional trades at these highs. A whole bunch of institutional trades are hitting here. So it's just not one, it's a lot. And we had a fairly large one here on this this breakdown here, a fairly large trade, and that since has resolved to the downside. So I want to point out also, when you're using the volume leaders, these are not directional signals. Okay, these are just telling us where the institutionals are executing price and what type of institutional trades they are. Okay, you know, this is not a directional uh, uh, signal. So be very mindful here. I think it is important that we are still currently trading above this market open. Okay, I think it was about the 19th or something like that. What was it here? It's probably right here. Yeah, 19th, the 19th. So holding above that 19th print, really important there. What is that? 247. So we know 247 is a major uh, potentially a major supporting area. So let's definitely keep that in mind. So it's not overly bearish yet. We are below the 20 SMA, or over below. What is that? No, that's the 9 SMA. Okay, that's not. We're below the 9 SMA, so the momentum has trend has broken. 1 second here, I'll tell you where we are on the 20. There we go. There we go. So we came all the way down to the 20 SMA. There you go. There you go. So we're right at the 20 SMA. It's do or die right here. So if we're coming in Monday morning, breaking Friday's lows, look out because we'll be losing the 20. So very, very, very critical area here for Apple. So Microsoft's just showing all kinds of relative weakness here. Be very mindful of that. We are at the expected move for the week. Okay, so and so to be made mindful of that. The expected move low on the breakout here. So we are closing below that breakout week. This is the breakout week right here. Currently, we are trading below that. That's more bearish in my opinion. Looks like a, you know, so be very mindful. You see this breakout week. You see the opening print of that breakout week. We're trading below 423.40-ish. So below 423.40-ish really potentially opens the door a lot lower here. So be very mindful of that. Okay. and that's actually an opening print trade right there. See, that's an opening print, same time, right where when I mentioned that 423. So yes, so it looks like a potential head and shoulders as well. So very mindful. We had a really strong trade right here, a fairly strong trade on Microsoft. I did notice that. Um, you know, that was last Friday, and we just haven't done anything since. So guys, we had another bearish signal here. We had a fairly strong trade on Nvidia, okay, and now we're currently trading below that fairly strong trade. So be very mindful that that's actually setting up a more bearish scenario. We know how much Nvidia was up for 2024, going into a brand new calendar year. I do not like this open, down here at this level here on Nvidia. Could very easily be running for the gate. So I definitely want to keep that watch. We don't have quite as a lot of chop area. This is a lot of chop area currently. We aren't in a very strong sell-off in the markets. We did not get down to the expected move for the week, so that would be one I'd be watching for first of the year selling pressure. So definitely want to watch this January 1 selling pressure. We breaking Friday lows early on Nvidia. We have the room to not even have an outside room all the way down to basically the 131. So be very mindful of that. That this could be one of the catalysts. First thing uh, tomorrow morning, uh, that they're just finally going to give up on this. And it was a bad close, in my opinion. This was not a very good close versus where the prior buying pressure came in. So Meta, we've had quite a few trades down over here at the FOMC lows here. Really didn't get any participation into the so remember guys, it was New Year's Eve, so a lot of institutions had closed their books for the year. So, the idea that they didn't trade, that, they could have been away from their desks and stuff like that. So we've come down into the support area. Um, really didn't get much upside so far. So all these trades right here, we really didn't get much upside. We closed actually a little bit below the opening print, that prior strong opening print. We actually closed a little bit below that. So be very mindful of that. A lot of sell side pressure in the markets, so be very mindful of that. Okay. No, it's over here. I think that's right. Right? No. Yeah, that's right. That's right. Yeah. That was the opening print right there. Yeah. Okay. Had to make sure there. Okay. There you go. And personally, the telecommunications area, Meta and Google, I think that's probably the strongest areas going into the earnings season. So just be very mindful of that. This is not the areas that I overly look into short. You got all the election revenues, election ad revenues that's going to be reported in this earnings season. So be very mindful of that. So this is not the area that I'm overly. So it's just like semis. You could tell we're going to have peak earnings, and since then we've had semis coming back down. Similar situation. Q1 is probably going to be peak earnings for the telecommunications. So that they could very easily hold this area up for the earnings report and then start selling off after that. So be quite mindful of that scenario. Okay. And here's some of the fair value gaps that are hitting right here, still above the 20 on the Google. Google's actually holding up really well because we don't even have a meaningful weekly fair value gap above us. So, it is holding up fairly well here. So it looks like to me we are building up value up here. So on Google. So be mindful of that. So this is the bullish take right here. This one here looks more constructive than any of the other mega techs. Amazon to me is the wild card as they've put ad revenue into their Prime Video streaming and Amazon Music streaming. So they're adding a whole new gambit of revenue generation to their platform. So similar with Netflix, whenever they added ad revenue to their platform, they just shot up to the moon, and I have to wonder how much of that's going to play into Amazon's earnings, because I don't think the market's fully realizing just we're coming off of probably a record high ad spending quarter, and how well this is going to play into the Amazon's earnings. This is one personally I don't want to be overly short going into the earnings, thinking that it might be Q2 before we actually see a resolution back to the downside. So be mindful of that. So guys, I'm going to try to cut it short here. Some things that I'm looking at here, possible themes setting up here. Maybe some bargain hunters trying to come in here into FXI. That's China names, so be very mindful of that. And few people realize that the Chinese equity FXI actually outperformed the S&Ps in 2024. It all happened underneath the hood, and you don't hear about it, but it's quite amazing what they managed to do over there, and nobody even talking about it. So, but typically, what you'll see a bit before a big spike in FXI, which tends to be on or off most of the time, you will see a big trade hit the tape before that happens. Now, this could be bullish or bearish. I don't know yet, but it makes more sense to be more, net long on China versus, but if U.S. equities start to sell, pare back their gains. So, just be very mindful, in my opinion, that we might be setting up for a early rally in the China names this year, as with some rotation happening. Okay. One last final trend that I'm actually looking at here is finally some additional monies rolling back over into the XLE here. So we are above this accumulation area that happened in the XLE. We'll see how it plays out here. It does look like we might have some legs setting up here to at least probably back test the 20 SMA at the very least here on the XLE. And remember, guys, typically you don't have a market, the beginning of any type of recession in the market until you've actually had an extreme out print in the energy and utility space. So, because what happens is the energy and utilities they drag away from discretionary spending typically, and that actually leads to recession. With us being a net exporter of crude, it's going to make it a lot harder to trigger a recession. So, so we need to really keep a close eye on this. Okay. We got ZNs. Let me go through that real quick. I can't. It's not going to show up on that one. Give me a second here. So, what I'm looking at right here, guys, is the ends. So this was the last Friday's close. We still closed below the Z ends. This is our 10-year bonds. So, in my opinion, in the down week that we've had, we might have seen some people going to flocking to safety in the Z ends. It's not necessarily a bullish sign for the Z ends. I do not think we're done. I'm looking for the it's 4.51%, I think, yesterday morning here on the yields on the 10-year treasuries, T-bills. And that was yesterday morning. Okay. We did come down a little bit here, so it's probably get back to 4.3 or 4.2 or something like 4.52 or something like that. I'm looking for a move up to 5.7. So that being said, I'm just itching to move my mother's retirement funds into some higher yielding 5.5, 5.75% CDs. So just holding off, and hopefully that'll play out the way I'm looking for here first of the year. But everything about Trump is quite inflationary, his policies and stuff. So higher yields makes more sense in the front end of his presidency, in my opinion. So heads up on that. If you liked the video, please like it, and retweet me, Gumby9662C on Twitter. I really appreciate that. And comments below, I appreciate that too. There's some things, primary themes that I'm looking at here. I do think this is going to be a January where rotation will be prevalent. Last year I was kind of looking for it, and tech just kept going and going and going. And I do think the institutions have tipped their hand that they're ready to take profit. So be very mindful, be very careful trying to trade tech. Thanks a lot.